Hey YouTube, what's going on? It's Patrick here at Vectorvest, and there's been a lot of talk about inflation recently in the headlines, especially with the most recent inflation numbers coming out at exactly what they were forecasting at, which seems like a good thing because inflation isn't growing faster than what they're expecting it. But as we've seen the market sell off because of that news, because as we've seen in the past and as we're seeing right now, good news is actually ending up becoming bad news because that gives the Fed less opportunity to postpone any tapering, and therefore that would hurt the free money flowing into the markets, keeping the markets moving higher, and therefore prices of stocks could go down. So we're going to analyze the market and see if there's any signs of a potential correction and how to prepare yourself with 3 different picks that I have lined up for you today to take advantage of a correction if one does occur. So if you're ready to see those picks, make sure to like this video, smash that subscribe button if you haven't already done so, and let's get into it. All right, welcome back. So what we've got here is the market timing graph only found in Vectorvest, where at the top we're looking at the Vectorvest Composite. If you're not familiar with Vectorvest, the Vectorvest Composite is an arithmetic indexed average of about 8,700 stocks that we currently track in the US market. And we feel this gives us a better representation on what's actually occurring in the market because it's not just looking at the Dow's 30 or the Nasdaq's 100 or the S&P's 500. It's looking at the overall market, so it gives you a better sense of what's actually happening. And then below there we have the MTI, or the market timing indicator, and this is looking at the underlying trend of the market. Then below that we have the buy to sell ratio, which is looking at the health of the market. And then finally we have the RT, which is looking at the short-term price trend of the overall market. Now the MTI and the RT are both cast on a scale of 0 to 2, so above 1 is good, below 1 is bad. That's as hard as you need to make it. The buy to sell ratio is simply a ratio. So above 1 tells us there's more buys and sells, or that there's overall market strength, and below 1 would indicate there's more sells and buys or overall market weakness. All right, so now we've got that covered, let's dive into the analysis. As we can see, and as you're probably well aware, the market has been steadily grinding higher over the course of the last few months and really throughout all of 2021 so far. And now with all the inflation talks, there's a lot of fear that the market could have a correction in the very near future. You're already seeing a lot of big institutions giving the warning, saying they're expecting anywhere from a 15 to a 30% correction in the markets within the next month or two. And so I decided, well, let's take a look at what the indicators are telling us, what the analysis is telling us, and make sure you're prepared just in case that situation does occur. All right. So we see the price has been steadily rising. I've been talking about this for the last few months in some of our other videos that I've done. But as we can see with our indicators, the MTI, or the underlying trend in the market, has slowly been deteriorating over that same time frame and is now currently below the level of 1, showing the underlying trend in the market is down. If we look at the buy to sell ratio, same situation. Less and less stocks are participating in the market as the market's been steadily moving higher. So that tells us there's not a lot of strength behind these new recent moves higher, hitting those new highs that you see the talking heads on TV talking about. And then lastly, we look at the RT, or that momentum indicator, that technical indicator. Well, as price has been moving higher, no surprise that that momentum behind those moves is slowly dwindling away. And we've been below the level of 1 on the RT for quite some time, really ever since the beginning of July. So this tells us, yes, while the markets are moving higher, we are seeing the underlying health and strength of the market slowly deteriorating, and that could set up for a potential correction in the market. Now, luckily here at Vectorvest, we do have some different market timing systems depending on what your investment style is, and can help you get in at the right times on the overall broad market and help you also protect your profits at the right times based on the overall market as well. So if you're interested in those timing signals, make sure to click on the link down in the description below and sign up for the trial right away. Okay, so now we've got that out of the way. We've seen what's going on. We have a good idea of what's currently happening in the market. Prices are steadily moving higher on stocks, but there's not a whole lot of basis to tell us that things will continue to go up. And actually, we're starting to see deterioration in the overall health of the market. So therefore, we want to be prepared and make sure that we have something lined up. So if we do start breaking down in the market, we do start seeing the market having that correction that everybody keeps talking about, you guys have a play ready to go to make yourself some money. Let's jump into those ideas. So the very first one we're going to be looking at here is Yang. Now, if you're not familiar with it, it's a China 3-time leverage ETF. And actually all 3 of today's plays are going to be ETFs, and they are going to be triple leveraged. So therefore they are typically known as aggressive plays. Now there are some opportunities to take advantage of that are double or single leveraged on these plays as well. But today we're going to be focused on the triple leverage, the more aggressive ones. And looking at Yang first and foremost, if you're not familiar with it, China's second biggest real estate developer is having some issues, potentially talks of default coming along or bankruptcy coming along, or what they want to call restructuring, however you want to word it. But those types of fears could boil over into the global markets and could cause some impacts seen not just in the US, but other markets as well. So with that all being said, with that big issue lined up and also the crackdowns they've seen in their markets as of late, the more regulation the government's trying to add, this could definitely be a smart move, or at least one to keep your eyes on. Now, as we can see, it has had a pretty substantial run ever since the lows back around February. It's been steadily moving higher, starting to pull back a little bit, but if things start getting interesting in China, this could definitely explode. Previous high for the year set back here on the 25th of September at 28 bucks. So about a $10 move on an $18 stock. Not a bad profit target. All right, so that's stock number one. Also, on the technical side of things, if we break it down coming into a 3-month chart, we can see the DPO, which is the detrended price oscillator, typically known as a momentum indicator, started dipping below the level of 0, now picking back up and right at that neutral zone right now. We look at the stochastics, which shows overbought and oversold scenarios. As we can see, stochastics hit close to that oversold scenario on that most recent pullback, but now starting to lift off as well, showing that we may be heading higher here. And then last but not least, we have the MACD, stands for Moving Average Convergence Divergence. And this is a great momentum indicator that can be used for both short-term and long-term trading. On a short-term basis, we look at the difference between the MACD line, or that blue line, and the signal line, or the white line. As we can see, the difference between those two averages are starting to converge, and we're potentially going to see on a short-term basis the momentum or trend of the MACD start to turn up, which could be a very positive sign in the very near future. So stock number one, if you like it, as always, smash that like button. Let's get into number two. Number two is looking at the Dow coming in with SDOW. Once again, this is a triple leverage that's moving inversely to how the Dow 30 is moving. The reason I chose this one, because if we zoom out to a 6-month time frame, I constantly talk here on YouTube and in other sessions that I do here at Vectorvest about divergences. Divergences are an extremely powerful analysis tool to be able to use, and if you can spot them early enough, you can make money. So I'm using the freehand line from the upper left and just drawing an overall trend here over the last 6 months. No surprise, we can see it's moving lower. Well, going back to that DPO, the detrended price oscillator, which is a momentum indicator. What is DPO doing over that same time frame? Steadily moving higher. So it's a very slow, long, bullish divergence that's being created here. If you look at the Dow and look at the DPO on it, you'll see just the opposite. Price has been moving higher. DPO has been steadily dropping, so therefore that's a bearish divergence. But since we're looking at contra ETFs, we're looking for the Dow to go down, which would mean these ETFs go up. We see a bullish divergence here. So this is my number two pick so far that we've seen. And then last but not least, the third is coming down for the NASDAQ with SQQQ. Now, the NASDAQ is tech heavy, no surprise there. And tech stocks seem to do the best when free money is being pushed into the markets, and these big tech companies can get money for 0% interest or basically free money. Well, if that starts tightening up, expect a huge pullback in some of these tech stocks, which have rallied significantly over the last few years. So therefore, that's why this makes my number three play. Also, just like we saw with SDOW, We have the price of this moving lower here over the last 6 months. No surprise. The NASDAQ has been steadily rising, but look at what the DPO is doing once again. DPO is steadily moving higher, creating that bullish divergence that I like to see. And now you may be asking yourself, well, when do I jump in? These are great picks, but how do I take advantage of them? Let's take SQQQ for example. If you're looking for an entry point, utilize trend lines. Let the trend be your friend. If we connect these lows here, these lower highs, we get a trend line. Well, when this trend line is broken and we have, let's say, confirmation of the DPO crossing into positive territory, that could be an early opportunity to jump on board. Now, this isn't saying load up your portfolio with triple leverage contra ETFs. Definitely not. But this is a time that if we see that breakout, maybe add a little bit to it to potentially hedge your portfolio or to turn a quick profit in a downturn. But however you choose to play it, make sure as always that you're planning your trade and you're trading your plan. So on that note, I hope you all enjoyed today's content. If you did, as always, and you haven't already smashed that like button, go ahead and do so now. Share this out with all your friends and family. And down in the comments below, let me know which out of the 3 is your personal favorite. So until next time, take care, adios, toodles.
Yeah.